So you're thinking about buying a home, and of course the first question is, what can I afford? The easiest answer is not necessarily the best answer, but that's to start with what you're paying for rent. If you're paying $1,500 a month, then you can probably afford a $1,500 monthly mortgage payment, but you need a better answer. I'm Walt the Realtor. Let's break it down. Lenders like to use your debt-to-income ratio, also known as DTI, to determine affordability. It's expressed as two numbers like 30-40. The first number is your mortgage-to-income ratio. If it's 30, your house payment shouldn't exceed 30% of your income. For a $5,000 income, 30% would allow you to carry a $1,500 mortgage payment. Now, the second number is your total monthly debt percentage, including mortgage, car loans, credit cards, student loans, everything. If the second number is 40, your total debt needs to be less than 40% of your income. So for a $5,000 income and a 40% total DTI, your total maximum debt is $2,000, including your future mortgage. And if these are the numbers that your lender uses, they have a 30-40 DTI requirement. Now, different loan types have different DTI limits. Conventional loans are stricter, while FHA, VA, and USDA loans are more flexible. And by the way, that $1,500 mortgage payment we're using as an example will include your home insurance, taxes, and various fees. And of course, those costs can vary. There are also two primary expenses you need to include in your calculations. The first one is homeowners association dues. You don't have to buy a house in a neighborhood with a homeowners association, but you might want to. Some HOAs charge just a couple $100s a year to maintain neighborhood standards, but others, they can cover things like pools, fishing ponds, trails, landscaping, that kind of thing, potentially charging fees of several $100s a month. But the bottom line is an HOA is there to protect your property values. The trade-off is that you have to give up some control over what you can do with your property. You want to convert your front yard into a vegetable garden? No way. You want to park your boat in the driveway? Probably not. It's annoying, but it makes sense. So let's say you live in this neighborhood. It's a nice neighborhood, right? Well, what if this person is your neighbor across the street? When the time comes to sell your house, you might have a hard time finding any buyers, much less a buyer willing to pay what your house is worth. Your HOA can avoid this situation by enforcing the rules through fines, liens, lawsuits, and even foreclosure. There are a few cases where HOAs have acted unethically, but when it's time to sell your house, a well-run HOA is going to make sure you get the best price. The next expense to plan for is maintenance, and this needs to be an ongoing investment sort of thing. And the math on this one's pretty simple. A decent rule of thumb is to set aside 10% of your normal mortgage payment into a maintenance fund. Put it someplace smart, like a money market fund, something like that. Most months you won't use it, but if the water heater blows up and floods the house, you'll be glad it's there. Even if it's an insurance claim, you'll still need to pay the deductible. Another option would be to pick up a credit card with no annual fees and use that as your emergency fund. Just put it in a drawer, try to forget about it. But regardless of which route you go, you're going to need to do something to be prepared for a little chaos. Your down payment is also going to affect affordability. A 20% down payment is ideal, but most buyers just can't do that. So if you can only afford a small down payment, it means a higher loan balance and added fees. For example, if you're buying a $250,000 home with 20% down on a conventional loan, there's no mortgage insurance, and you get a good rate. So this becomes about a $1,733 monthly payment. Well, let's say you don't have any money for a down payment. VA and USDA loans are options that don't require a down payment, but they do include extra fees rolled into your mortgage. And FHA loans allow for down payment assistance, like receiving a gift from family or using Missouri Housing Development Commission programs. Fees, interest rate, and mortgage insurance will vary depending on which route you go, and your monthly payment would be somewhere between about $2,104 and $2,258 a month. Okay, so here's where we are so far. First, take a hard look at your debt-to-income ratio. What's your number? If it's high, then you need to get it paid down as much as you can, as quickly as you can. Next, Think about the monthly payment you can afford. How much rent could you pay for the house you live in now if you also had to pay for maintenance and HOA fees? Third, think about your down payment. If you're carrying a lot of debt, it makes more sense to spend whatever savings you have on getting that debt down. But otherwise, do whatever you need to do to set some money aside. And finally, talk to some local lenders. Even if you're an introvert, you need to call and ask to speak with someone in the mortgage department. And I'd say talk to at least one traditional bank, one credit union, and one mortgage broker. Lay out your entire situation and ask them to figure out the best mortgage package for you. A pre-qualification is going to tell you what they're willing to lend you. Add expenses and your down payment, and boom, there's your budget. And once you have that number, you'll be able to decide if it's time to get serious about shopping for a home. And if you are, and if you're in the Southwest Missouri area, give me a shout. Just scan the QR code to visit my website. All my contact information is there. Or you can email me at WaltMyRealtor@gmail.com. First thing we'll do is get you a legit pre-approval, which means you'll actually have a mortgage in your pocket ready to go, and then we'll go get you that house. That is it for today. I hope that helped. Be sure to like, subscribe, and comment with any questions. Thanks for watching. See you next time.